Hi, Amy.
Hey, Rachel.
All right. Welcome, everyone. All right. So I am Rachel Shepard. I'm Director of Global Marketing at Founder Institute and co-creator of the Female Founder Initiative. The Founder Institute is the world's largest pre-seed startup accelerator, and we've helped over 4,000 companies, get started, build, grow their companies across 185 cities and 6 continents. If you're interested in learning more about Founder Institute, we're currently enrolling across all 6 continents, and you can see that at fi.co/enrolling. But without further ado, I'm here today with Amy Wu, a partner at Lightspeed Venture Partners. Amy joined Lightspeed in 2019, having previously enjoyed both sides of the table as both investor and operator. Amy was an executive for several years, most recently at Discovery, a global media company with over 17 networks in 220 countries, and at NewsCred, a growth stage marketing software company based in NYC, where she helped raise over 60 million. She's got a BA from Harvard, majoring in biochemical sciences, and has summited over 14 alpine peaks, over 10,000 feet high. So Amy's generously provided her time today to share best practices for cash planning during what can only be described as one of the most uncertain times we've seen in at least my lifetime. And we're here to answer some pressing questions that we know founders have today. So Amy's going to go ahead and cover some best practices and tips that she has put together for the company she's working with personally and has so graciously decided to share with all of us here on the call today. And then we'll go into some Q&A after that. So go ahead, Amy, take it away. Tell us your best practices.
Sounds good. And just to check, I'm assuming people can chat, right?
Absolutely.
Questions anytime. Well, hello. I see it now. Hey, everyone. Thanks so much for your time. And I know this is a really stressful time for everybody, particularly for founders. And so really appreciate your guys' time and being on. And also, it looks like we got quite a few people from around the world, actually, which is really exciting. So just to give some context, at Lightspeed, we're a full life cycle fund. We have 450 portfolio companies at all sorts of stages of growth, all pre-IPO. And so I'm spending 120 hours a week right now, just talking with founders and CEOs across our portfolio, helping them manage cash, helping them reforecast, and we have a spectrum of both enterprise and consumer companies that are facing both headwind and tailwind from the virus right now, and there's a lot of stress, and so I wanted to just have an opportunity to share some of what I'm seeing and be able to answer some questions that you guys might have. Obviously, I don't have all the answers. I don't have a lot of answers, but so I think we're all trying to learn from each other, and I just want to provide whatever information that I can. I think I'd like to start off with just want to acknowledge that everyone is very stressed out, and no one more than founders, because you guys have to be stalwarts for your employees and be confident for your employees, and in the face of a lot of challenging decisions that you have to make right now. And so I just want to acknowledge that and hope that you guys are taking the time to make sure that you're thinking about how to make sure you're getting exercise and focusing on your mental health, and also making sure that you have your mentors or board or peers that you can talk to, because the life of a founder is lonely as it is, and right now it's only gotten lonelier. So just want to start with that, and so I would say for in terms of Lightspeed's view, we have the founder of our firm, Ravi Matra. This is his, I think, 4th economic recession that he has been through, and so we have been talking a lot internally around where how deep we think the recession is, and also speaking with a lot of different stakeholders in the hedge fund world and banks, etc., just to kind of get some data points. And I think from generally what we're seeing, what we are advising our portfolio companies around, is that the drop in the stock market, it was like a stock market shock, was very fast and steep, and Catalyst Partners has released some data points to show that companies that market drops that happen that are very steep typically results in a longer term recession. And actually, the longer it takes to hit that bottom, the longer it takes to get out of. And we think it's going to be like a couple of years before I think economic demand really recovers, and we're at the first innings of what's going on right now. And as a result, like the reason why all of us at Lightspeed are immediately turning inward into the portfolio and working with our founders is because first, most of them, I want to say, have actually not been in their position like as a founder in any recession prior to this. And so there's a lot of confusion, and there's also a good separation between like our CEOs and founders that have lived through a couple of these and know that they need to act decisively and take the pain like early, and also not death by a thousand cuts. And we'll talk about that in a second. But most of the founders are like, oh, let me assess the situation. Let me just collect some data. And we are essentially advising companies to just assume that unless you're in one of the few categories that have tailwind in this right now, so I would say productivity, enterprise, remote work, like obviously Zoom and Slack and others, or if you're in, for example, online food delivery, we're seeing like huge tailwinds in the sector, so online grocery, etc., that for the most part everyone else is adversely, I mean, maybe like also biotech, maybe like tailwinds there. Most other industries are all facing tailwinds from the virus, and so in most companies, we are advising on taking fairly substantive cuts in their top line forecasts for this year, and not forecasting full recovery even next year, particularly, for example, if you're an enterprise company selling to B2B companies, where in the prior recessions we have seen that it's going to take probably 2 to 4 years time to fully recover to to the demands that we were used to seeing, like honestly 3 weeks ago, which is pretty crazy. And so I think so we're advising companies. Well, actually, first let me just hit a quick pause and talk about fundraising, because I already saw a couple of questions in here around fundraising. I would say the fundraising landscape has dried up very, very quickly in the last couple of weeks. I mean, I'm probably on about a dozen live processes right now, like fundraise processes across our portfolio, working with our companies around raising money. And the ones that were very far along, as in like they had gotten a term sheet already, like when this happened, we're seeing term sheets being retraded and pulled across the portfolio. There are some that are going through, and it's really on a one-on-one basis. Like, how strongly does a fund want to honor that, and obviously like a fund's integrity and how they deal and act in situations like a recession has a big reputational impact over the long term. And so we do see a lot of them want to do the right thing, but we are seeing terms being retraded, prices being cut, like terms like liquidation preference, participation, seniority, all sorts of terms that I haven't seen since the last recession, like come back, like when I was at Insight, like come back here. And so just be aware of what, if you are fortunate enough to be far along enough to be in a fundraise process to have gotten a term sheet, be aware of this environment. And I would say for everybody else, I am seeing very, very few term sheets being actually given, and for companies that absolutely need funding, that you immediately talk to your existing investors around supporting you with either a convertible note or around potentially like at your last round validation, or maybe a small step up from there to be able to close it very quickly, because I want to say like most growth funds and institutional funds that I have spoken with, no matter what they are saying online, they are pencils down right now and not funding new deals for the most part, unless it's an entrepreneur they know very well, and they're essentially on a holding pattern to wait and see like what's going to happen in the markets. And yeah, I totally agree. Pulling term sheets is very not cool. We're on like the the side of the table. I've been on the side of the table. A term she's getting pulled from our company is definitely not cool. And so, like, I would say if you're going into a new fundraise process, you should pretty much expect that it will be near impossible to raise from an external fund that doesn't already know you. And so I would very quickly also talk to your existing investors to see whether you can get support from them quickly. Let's see.
What are you seeing, Amy, regarding that? What are you seeing founders do if they've only raised from angels at this point? They're very early stage. They've maybe raised a bit from angels. Would you recommend they go back to them? It's a little bit different when they're individuals and not institutional investors. Can you share a little bit of your thoughts on that?
Yeah, I mean, in talking with angel investors, what I saw was that, YC recently had a demo day, and the demo day kind of coincided with the beginning of all of this, and I did notice that companies were getting themselves funded because I think like the earlier stage investors, the more of a lag time there will be in terms of both price adjustment and general bearishness. Although at this point, with the market being down 35%, even angel investors may be more conservative. Although I talked to my angel investment network, and there's very healthy debates from people being like, now is a good time to fund, we have no intention of slowing down at all. Large institutional platform VCs with hundreds of portfolio companies naturally right now will be looking inward toward their portfolio and making sure that to minimize portfolio companies going out of business. And that's one of the reasons why they just do not have bandwidth to be taking on a lot of new meetings right now. But I think like for smaller funds that very quickly have already done this exercise, and they might be going out and be more willing to actively engage with new companies right now. And so I think you'll see a spectrum, and the later the investor, the more they're going to be focused inward right now, is my hypothesis, and also from just like talking with some of my peers and other funds.
Fantastic. Thanks for elaborating on that. I think that'll help some founders who are at the very, very early stage right now get a sense for what that environment looks like.
Yeah, and I would just try to reduce friction. I would really reduce friction. Like I would not be hung up on your cap, like, and in terms of, and try to just raise what you can. In either a safe note really quick, or if you're pricing the round, to just not be too, I would not negotiate this is not the time to negotiate super heavily on like, like an optimally like priced round. You're just like trying to get capital in to survive through the recession. That is the priority, and honestly what we're trying to work with our companies on right now.
Excellent.
Any questions around that has come up, Rachel, or I can keep moving?
Let's see. So, we can keep going through this, but through, moving on, because I know you have a lot of things you want to cover and a lot of suggestions for founders, but a couple of very specific questions that have come up is, I have a pre-seed stage company, and I have a revenue forecast with my pitch deck. Would love to hear more about reforecasting revenue projections for funding. Once things are looking a little bit back to normal, which, of course, no one knows exactly when that'll be. But hopefully, maybe, I know you have some very specific suggestions on revenue forecasting in particular.
Yeah, we'll talk about that. The reality is no investor is going to believe your plan right now, because nobody knows how hard, plans will be hit. And so I think it's going to be, you don't even need to change it. You can literally say, I think speed is really what you want to optimize for. You have a deck already. I would just go out and just say, I don't really know what's going to happen in this recession. Like, most likely we're going to have to cut down the plan. And I just want to be upfront about that.
Another question a founder had was, regarding, in your opinion, and honestly, this is a very good and straightforward question. Is now the time to still start a startup and build a company with the environment looking like it is? I know we've got a lot of ways that we can help existing companies, but what are your thoughts on that?
It's a good question. There is no best time to start a company, although, right now, because funding is really dried up, it's harder to get a company funded. I think, you see in every recession, there are tremendously strong companies that are founded and built, because in this environment, you don't have a large margin of error in burn rate at all. And so what you see in a recessionary period is startups being founded that are a lot more capital efficient. And but that having that discipline in a recession when it's so much harder to like win a customer just means that you do that much better in a bull market when you have that DNA. And that is essentially what, like we saw, I think, coming out of the last recession. You see these tremendous businesses that were built that are very cash efficient, and I would say and like these strongly operated businesses. So I mean, if you have a strong desire to start a company right now, I would still encourage you to do so, but just know the environment that you're getting into in terms of funding. Yeah, new wave of bootstrap companies. I totally agree.
Yes, absolutely. And kind of on that same track, I have one more question sort of related to what we're talking about is, even prior to COVID-19, there's been a lot of a rallying cry from investors stressing the health of unit economics, cash management, clear path to profitability. Do you feel like that is compounded with COVID, and are terms going to be different now? So you kind of touched a little bit on terms, but what are your thoughts on that?
Oh yeah, I mean, absolutely. I think what an investor is, when investors are back out into the market, because like there's going to be a lot of funds that are not going to be able to raise new funding. And so like the thing how it works is like larger funds for like Lightspeed, Accel, Sequoia, like these large iconic, these funds that are lifecycle funds, a lot of the capital, they're all focused internally in the portfolio right now. But like in probably about a month's time, they're going to all be coming out and looking for new opportunities, and at a time when smaller funds that are in the process of raising a new fund, et cetera, are just not going to be able to do that in this environment. Just like for companies having a hard time fundraising, funds will have a hard time fundraising as well. And so as a result, you're going to be able to, you're going to see like funding start up, but like with different terms and with different expectations. I think what investors will want to see in 6 months' time is that you as a founder made the hard decisions like upfront. You were decisive, and but you weren't like cutting to the so much. It's like balancing like existential survival with also being aggressive when you have cut your cost basis to a point that you're very, very lean, perhaps even like cash flow break even. Like I think John Chambers recently did a talk with Iconic, and he co-invests with us, John Chambers, like ex-CEO of Cisco, and he was saying how like actually in the last couple of recessions, Cisco doubled down, made the hard decisions, and then was aggressive in areas that they really need to be to emerge out of the recession as number one position in a lot of the markets that they're in. And so we also are keeping an eye on, like, in a recession is actually a good time to be aggressive as well in hiring, et cetera. But after you have made the decisions, the steps that you need to do in order to cut your OpEx to the point where you can just survive. And so why don't I get into more prescriptive, because I started seeing a lot of specific questions around cash planning.
Yeah.
So in terms of extending cash runway, we are recommending that you are producing a plan to extend your runway to 24 months plus, which is a lot. I mean, arguably, if you can get it out to 18 months, that's probably okay. But in general, like we are working with our companies to get to 24 months plus, and that means a couple of things. The first thing is around just your capital. A lot of companies have a line of credit. And as of last week, we're telling them to go out and either raise or augment and also extend the maturity date of your existing line of credit. Now, in the last couple of days, I have spoken with all major venture-backed lenders, and for the most part, maybe with the exception of SVB, most lenders are actually not taking on new conversations for now. And so that really changed. That was a dynamic that changed very quickly, because what they saw was that they saw their existing companies immediately drew down on their loans and on their lines of credit. And so in order to keep their ratios, their reserve ratios up, like they have essentially hit pause on new term sheets for lines of credit or for revolvers. And so this is something to be aware of. Like, they've all told me, like, we're going to assess, we're going to focus on companies in which we already have an existing banking relationship around. And so before you spend a lot of cycles and reach out to like 10 different lenders, that is something to keep in mind. The other thing I would say is that the stimulus package that just passed a couple days ago does have large lines of credit to bolster the balance sheet of lenders. And so like there's probably going to be a little bit of time to transfer some of those funds over. And then at that point, I'm assuming that lenders will continue to be able to lend again, but there's going to be a little bit of lag in that time period. So also extending runway, I think most companies should talk to their existing investors to see whether, it makes sense for them to actually for you to raise a small amount of money just to extend runway. Again, easiest thing to do is be like, we're going to open up our last term sheet and, can we raise an extra million, 5 million, 10 million, etc. Like just to add cushion. You want to do this as quickly as possible because I suspect that it's going to be harder. It's going to get harder, not easier. For a while I was recommending people not to draw on their debt, but I think that, especially if you are under 12 months of runway right now, you should probably draw on the debt. But do take a look at what the terms on your debt are, because if you have a term sheet with a lot of covenants, as a fund, we have seen many times like companies break covenant and then your bank account will get frozen like by the bank, and it's like pretty much a nightmare. You can't run your business. Like lenders are not going to be like very forgiving at the point in which you trip up your covenant. So I would really take a hard look at that and make sure you do everything that you can to reduce OpEx first. And then like in terms of thinking about your forecast, I'll touch upon that really quickly. So on the forecast, what we're working with, like for example, what I'm working with across our portfolio is that most companies have already created a plan immediately that's taking down their top line revenue for projections for this year down by like on the enterprise side, I would say by like 25 to 30% off the bat. We are recommending that they're actually taking an approach where they're planning to about 50% reduction in bookings for the year. And a lot of these companies are not going to see the pain in Q1 necessarily because of enterprise sales cycles, but you will see the pain in Q2 through Q4 because like I'm on the phone also with like our strategic partners like Discovery, like SAP, other larger companies, and they basically are like have frozen up like new vendor spend. And so I think we know that in a recession, enterprise IT spend is flat to down and will no longer grow. And so that means, less focus on buying vendors from an innovation perspective, digitalization perspective, and enterprise companies are all going to be like cutting costs. And so that is like how you should revise your pitch to. But then be sensitive to what your customer or prospective customers' needs are. But then secondly, do understand that like sales cycles will be augmented, pre and post, like I would say, like, shelter in place, and just to be prepared for that. And for consumer companies, well, we'll get to that in a second, but for consumer companies also, there are, again, some of our companies, like particularly entertainment space, short form video, etc. In the short term, a bunch of them are seeing an acceleration in their business because people are bored at home. They're not spending on real life entertainment, and so they're spending on digital entertainment. But what happens in a recession is, like, of course, like with more and more people getting laid off or furloughed or with like salary reductions, people's disposable income goes down. And so ultimately, we do expect most of our companies, even facing tailwinds right now, to see a reduction in their revenue forecast for this year. In modeling, because there's so much uncertainty in how your business is impacted, we recommend doing multiple scenarios. So like 20%, 50%, 80% miss on top line. There might be, there might be potential downside in gross margins. There will definitely be impact to working capital for the most part. So, for example, it will take you longer to collect money up front. If you're a B2B business, they will no longer be paying you sometimes 3 years or even 1 year upfront. And so I think a lot of companies, at least in our portfolio, are not baking that into their capital needs yet, but this will very much be impacted. if you're a consumer business and you sell physical goods, supply chains are being disrupted right now, of course. And so like, if you're a company in this space, you will already have felt it. And so a number of our like direct to consumer companies, for example, are seeing that disruption, and they do have like stockpiles of existing product for a number of months, but it's like very, very difficult for them to release new products, and that's something that you've got to bake into your into your forecasts. And so adjustments in inventory planning, purchasing cycles, just general disruption, supply chain and distribution. And in each of these scenarios, we ask that our founders understand what it is that they need to do in order to maintain that ideally 24-month cash runway, and get alignment across their executive teams and with the board in order to take the steps that the company needs to achieve in order to survive. And that could be like, if you're 20% miss, then you're freezing hiring, you're doing lighter weight things, you're really managing your variable costs, and with a larger miss, then you're actually like cutting into personnel. But I think alignment is really key, and our companies are doing like weekly all hands with their companies, but then with their board. Some of them are actually doing weekly emails or calls with their board. Some are doing like bi-weekly calls with the board. But you don't want any surprises with the board, because you may well be going back to them to ask for more funding. And the more they're on your side, like the better, the smoother a process that's going to be.
Awesome. Amy, I have a quick question from, Susanna jumped in, and she had experienced some investors back out about a week ago or so. And now she's thinking about maybe a small business association loan. And so things like that. Are you seeing any other resources pop up that founders can turn to, especially if they've just lost an investor, like they almost had it or almost at term sheet? How do you, what do you think is best for them to go and do immediately after having that happen?
The first thing I would do is reduce cash burn. I think this is public. TripActions, our portfolio company, was in the travel space. They're heavily impacted, over 90% like of revenue impacted immediately. And for a company like that, they immediately had to fire, over 30% of their employees. And so in order to just survive, and this was a company that just raised another round of funding just 6 months ago. And so companies are, if you absolutely, I'll talk to SBA loans in a second. And I would say this is something that, because the stimulus package was just passed, the tricky thing with SBA loans is that the language is not clear about your eligibility in terms of to apply if you are a venture-backed business. And so that is something that we are absolutely like talking with our lawyers on real time to get understanding of. But maybe I can I'll go through just the immediate expense reduction steps, and then we'll get to what we know so far around the stimulus package and what you guys can expect. But and then I will update the sheet that I have as we get more information from our lawyers in the next couple of days. So immediate expense reduction. So we, across our entire portfolio, no matter if you have 3 years runway or not, we're asking them to implement a hiring freeze. And this is something that they should to reassess on a quarterly basis. And so again, if you're lucky, you're in a company, you're in a space, you sell a product that's less impacted in a recessionary period, then you may actually have the ability to bounce back and start hiring again sooner. But I would say most companies do not know whether they're in that kind of position right now, and so as a result, immediately freeze hiring. We recommend that you essentially go down your list of your top vendors. So look at all of your vendor relationships, sort them from top to bottom, and start renegotiating every single one of them. So for example, real estate, your suppliers, logistics vendors, AWS, Salesforce, etc. Those are all contracts that even if you just signed a month ago, even they're going back to the companies and they're like, we're literally going out of business, and we will not be able to pay if you do not give us a cut in fees, or help us actually postpone your real estate costs. for a couple of months, etc. And we have companies that, because everyone's working remote right now, and if they're, for example, working in a co-working space, month-to-month co-working space, they're literally just eliminating their real estate lease entirely. And then there are like services that can essentially like box up your like furniture and everything and help you like move out of there. And that's like probably a pretty large expense for a lot of people. So we've got companies in our portfolio doing that, absolutely. Extend the payment terms on some of these contracts, and but then more importantly, just renegotiate them right now. I would delay all other non-essential CapEx spend. Other things that people are doing, companies are postponing annual merit increases. They're also they also are doing like progressive salary reductions across the company, and all of this is to prevent like firing people. Essentially, they're going to do every single step it takes before they have to like start cutting people, and so for some of those companies, they're actually granting equity grants in lieu of either merit increases or like to make up for some of the gap on salary decreases they're doing. I would, a lot of companies now don't have T&E spend, they don't have events and other marketing non-essential spend, and all of them are banking those savings. They are not allocating them somewhere else. A lot of our consumer tech companies are just cutting marketing entirely. And actually the entire industry, like large brands, small brands, are all cutting marketing spend. And that's why you see this huge hit in the advertising business, digital advertising, television, etc. Because people aren't buying people aren't buying stuff. Like there's no need to like market to them right now. And like I would recommend banking those savings. And if you're a company that just has to make the deeper reductions and deeper reductions in OpEx, and we recommend a couple of things: that you take the pain right now, like early and at a one-time basis. What you don't want to do is you don't want to like cut a little bit now and then in a couple months time cut again, because there's nothing that kills morale like more than just continuous cuts. And also, if you cut substantially into your OpEx, companies are reducing OpEx right now by both variable and fixed costs by like, I would say 20 to up to like 50%. And they are you're that much leaner going into this in what will probably be a more prolonged recession. And so for companies that have to cut deeper, they're targeting projects and regions in their company to just like eliminate, and they're doing like a bottom 10 to 15% performance-based RIF. They're also converting full-time employees to part-time contractors. They're also furloughing employees. So those are all things that our portfolio companies are doing right now. Let's see.
Yes, and you mentioned too, there's a lot of different, we have a lot of people on the call today who are from all over the world. So, there are government relief programs we've spoken specifically to for the US, but definitely, make sure to check those resources in your country, in your region, and look for opportunities that your governments are taking to respond to this current situation, right? So different governments are handling this in different ways. And so we're speaking a little bit specifically to the US, but there are opportunities in a lot of locations, depending on where you are.
Before we touch on the stimulus package, I think Leonard had asked how does Lightspeed differentiate between early stage and growth? And I would say a lot of this advice, certainly the getting the cash runway, et cetera, is going to apply to both. We'll say that our take is that for a lot of our early stage companies, they don't have a very large cost basis yet, right? They've got maybe like a handful of employees, and so that means a couple of things. One, if you have a short cash runway, then it's going to be very difficult to raise more money right now, and so you might actually just have to like cut pretty deeply in order to survive. But for the companies that do have the cash runway, you have a lighter cost basis for the most part, and and that keeps you like more light and nimble. For our growth companies, a lot of them have hundreds of employees. They have a lot of fixed expense, right? A lot of it's not variable expense, and so that's why they're having to make these tough decisions to cut into their fixed expense, and that's what we're currently walking them through right now. So a couple of Oh, sorry. Go ahead, Rachel.
No problem. First of all, we're getting excellent questions, so keep them coming in the chat. We're going to really dig in on some of these things and make sure to answer your very specific questions too. So thanks to everyone who submitted so far. We'll keep going through them. Question about, sort of curious if any angel networks and or investors are looking at, you said most of them are pencils down, but are they looking to fund or at least have conversations with companies that are solving issues directly, direct or secondary to solving issues associated with COVID-19. So, for example, like health companies, companies that are really trying to make things happen, that can be really impactful to global health.
I think if it's direct, it would need to be like very direct. For example, we were looking at companies that were accelerating, testing. And also, I mean, we have a biotech practice, and so they were looking at vaccine development right now. But that's pretty much it in terms of what we will look at with direct impact to COVID alleviation, at least for us. I think, other funds might see it differently.
Okay, awesome.
But for example, we have, speaking of like Vision AI, we one of our portfolio companies is AnyVision. They're in the computer vision space, and all they're selling and also donating their services to governments right now to help them with like managing COVID and not just like manage this Israeli company. So they're helping them manage like tracking people who might be infected. And so I think companies are getting super creative around ways to help, which is awesome. But obviously, make sure that you're also washing out, looking out for you for yourselves and making sure that you just got enough. You're planning to survive for another day, type of thing. And I'm gonna just like say a few things on the just on the stimulus package. And again, I want to hugely caveat that this is freshly. Like this is very fresh, and we're talking with our lawyers to really understand it. And I think the biggest confusion around it, even for us, is just like, what are the limitations for venture-backed businesses via the affiliation rule? I think you'll start to hear that. And so in general, like in the short term, like there's a couple of things that that we will that you guys are going to see, that there's a deferral of employee social security payroll tax payments, and so that's going to probably free up some capital for everybody, since this is like these are tax payments that pretty much anybody with employees will are paying today. And if you are using a PEO, this is wrapped up in the cost of your PEO. So if you're using, for example, JustWorks or somebody else, so FYI, like, if you're confused, like, oh, I don't actually make these tax payments, you're doing it probably through your PEO. Something to like ask them about. Refundable employee retention credit. This is for companies that have seen operations fully or partially suspended by government order and have seen gross receipts fall by more than 50%. There is a refundable credit of 50% of wages paid up to a total of 10K per employee. And the caveat here is that firms that use this credit will not be able to access the SBA loans. And so this is like my current understanding. And so take a look at that carefully. And maybe that is changing. That has changed over the last couple of days. Then there's unemployment insurance for furloughed workers, and that's something that we're trying to understand right now. But when you're thinking about like layoffs versus furloughs for furloughed workers, then you can actually get some sort of there's a provision in the stimulus that's going to allow government for you guys to, I think, get some sort of payment share the payment. Or insurance burden, sorry, not salary, but insurance burden with government assistance. On the medium terms, like there are 3 large lending facilities in the bill, which we are tracking. And so they're like small business lending facilities. There's also just like Federal Reserve Main Street lending facility, and also for mid-sized businesses from 500 to 10,000 employees. And so these are going to be for the SBA loans. That's where we have a lot of questions around what happens with venture-backed businesses that I will get back to the group around. We're literally like understanding this on a real-time basis. But for the main lending facilities, those are essentially going to be those are lending facilities constructed to be able to provide financing to banks and other lenders to be able to open them up to make direct loans into companies again. Because like I mentioned, for a lot of our lending partners, they have stopped taking on any new relationships in our portfolio. So those are high level, like the key parts of the stimulus. And as pertains to like business like support, and so like again, we're trying to understand as quickly as possible, and I will update the news for folks.
Awesome.
Clearly for the US.
Yes, yes. So specific to the US in this case, but so for founders who are trying to figure this out, the stimulus package and how it applies to them, do you know of any legal resources that they could work with? Let's say they're really early stage and obviously they're trying to save as much money as possible. Do you have any recommendations or see any founders leverage that?
So yeah, so what's happening is all of the major law firms, Latham, Goodwin, Cooley, et cetera, are very quickly digesting the stimulus, and they're going to release sort of like open to the public literature around how to interpret it for venture-backed businesses. They're creating the content right now, and so that's something to just watch out for. So probably a lot of you guys are working with one of these law firms, and just ask them for the content.
Fantastic. That's a great sort of action item for founders on this call, is to get that information from the legal firms, know where you stand and how this applies to you. Okay, great. So we've got some questions coming in from the chat, and I'm going to go ahead and kind of run through some of them. So Wilson says, we're planning to launch a product next month. Is this a good time to launch? Do we delay? Obviously, product launches, it depends on what industry they're in, and
yeah,
also,
I think it totally depends. And again, like, there's going to be, think about like the change of of people's behavior as we're going to be all isolated and staying home for the next potentially couple of months. And so what I can share, and also I'll mention like Octavia's question around, like, absolutely, there are companies that are very much facing acceleration in their business because of all this. And I can touch upon a couple of examples of that. But in China, what happened was, during January, essentially, when there was mandated, everyone was staying at home, you saw, for example, like gaming went up something like 80%, like month over month. And then all forms of digital entertainment, whether it's like video streaming, short form video, like TikTok, and then just social media in general, were up probably about 40-50% month over month, in terms of a quick change of behavior. Online learning went up more in like the 50 to 80% month over month range. Online learning happens to be something that in Asia is already like a much stronger, like, I think, industry than in the US. And so, like, people, we might experience, probably will see it like a acceleration there, but maybe not as much as in India and China. And then probably the biggest acceleration is in essential items like what Amazon's selling, and then in online food delivery. Because again, people can't go to restaurants, they can't actually like leave their homes. We are investors in an online grocer, and they basically are seeing something like 15 to 20% daily growth right now. And with people essentially just buying, they're like panic buying, they're essentially going to the grocery store in person less and less, they're buying more online. And for food companies, like whatever, so far, for the most part, particularly if your suppliers are all North America, for the most part, today there hasn't been like a ton of supply chain disruption, thankfully. And what these companies are, the only thing gating them from growing even faster and online food delivery, and that's like Daily Harvest, like in our portfolio, or like we in our portfolio, is actually distribution. Like, they literally are out of warehouse space, and then they can't like actually deliver they don't have enough like trucks, they can't onboard enough like delivery people fast enough. And so that, like, including Amazon, is I would put Amazon category, but like Instacart, I think, is like hiring hundreds of thousands of people as well. And then smaller online food companies are all experiencing the largest pull of, I think, any industry right now. And then followed closely by remote productivity software companies. What China saw, interestingly, immediately, like in March, essentially, when people, well, in China, I mean, they flattened the curve. I mean, hopefully, fingers crossed, it doesn't rebound, the virus doesn't come back on them. But like when all those restrictions were lifted and people started going back to work at the beginning of this month, what they saw was that online forms of entertainment, like gaming, social media, video, pretty much dropped to pre-COVID levels, almost immediately. Travel, there was a lot of pent-up travel demand, which also came back not to 100%, but probably to about 30 to 50% immediately, coming up from near zero, I would say, like in China, which really speaks to kind of like the resilience of the travel industry. But we saw like some of the for example, like luxury fashion, and then also and so like interestingly in China at least, online grocery delivery was hugely up, but actually online prepared food delivery was down because people were worried about spreading virus through like prepared food. And in March, what we saw was that online grocery continued to be up because people were still skeptical about like, ordering food online, ordering prepared food online. So that was like an interesting just behavior trend. And this is a report that that like a large like digital ad agency had put together on consumer behavior before, during, and after COVID, which we thought was super interesting.
Yeah, one of the questions I had sort of related to that is what would be your advice for companies who are either maybe experiencing a tailwind right now, and so they're doing really well and preparing for that to sort of collapse back down as soon as people are able to go outside, or I'll say that. And then secondly, if founders are considering a pivot, if there's a way that they can sort of fit closer to a tailwind than they were originally structured to, do you recommend that, based on the uncertainty? And so what are your thoughts on those two things?
Oh, I mean, companies are very nimble, and they've already pivoted. I mean, like in our portfolio, they've already pivoted to try to capitalize on either, if you're on B2C or on the B2B side, like understanding your customers, what your customers need. They've pretty much done it. They've done it through their messaging to them, and they've done it through the products and services they were providing. And I would say, so what was the first question that you had asked again?
The first question is really, so like, and it even applies to a pivot. So if you've pivoted to sort of adjust to this new world, and or you're already experiencing a tailwind, how do you then start to prepare again for a change again in behavior, right?
Yeah, I think people are on the spectrum of figuring out whether a lot of these like new consumer behaviors will be locked in. And I would say U.S. consumer behavior may be different from China, because China, like, things went back to normal in about 1 to 1.5 months time. Like in the US, we're in a prolonged isolation. And so like some of these behavior changes may actually take a lot longer to actually to bounce back. Or not, like we really don't know. And so for the companies experiencing tailwinds, a couple of things. If you're in the online food delivery business segment, then we do see your tailwinds continuing on for some time. But I would just make sure. But we absolutely expect like levels to normalize again, like post COVID. And so we're telling them, like, you're signing up all this additional warehouse space. Like I wouldn't like sign multi-year leases right now. See where you can be super flexible, go month to month if you need, etc. Right? And also be very aware of what your retention curves looks like before COVID. So in our portfolio, we've got like online D2C companies that had like 12-month retention rates of like well under 50%. And then we had D2C companies that had negative churn. Literally, their 12-month retention is over 100%. If you are in the very high retention category and you're seeing that acceleration in your business, then I think it's probably a good bet that like you will actually retain a lot of those customers, and you're generally like your level of business is going to be sustained. But otherwise, you should just kind of expect a reversion to more closer to pre-COVID behaviors. And so I would not lock yourself into significantly higher, like, CapEx, just because you're seeing a lot of acceleration right now. So stay nimble, I would recommend.
That's awesome. And then just a very specific question coming from Chang related to food related in the industry. He said, you had a comment passing the food tech plant-based meat sector potentially seeing a huge tailwind. Can you elaborate on your insight specifically to plant-based meat? And if you're seeing any sort of effects on that industry in particular?
We unfortunately don't have any portfolio companies in that specific segment, but I will just generally say that the behavior is people are trying not to go, outside and actually go to the grocery store, right? So we're seeing just generally shifts of like online, like food delivery, meal delivery. And so if you're plant-based meat, or if you're like straight up meat, like, you're probably going to just see acceleration. And so I think like in there, it's like making sure that consumers know, right, that you're delivering and how quickly you can deliver. And so in those companies, like, for example, in our online groceries and a lot of our DC companies, they've actually turned acquisition marketing down to zero, and they are still seeing massive acceleration right now. The reason why they've turned off their acquisition marketing is because they literally cannot like fulfill the increased demand. But I have also talked to other online food companies where they're still spending on acquisition marketing in order to stay like top of mind for consumers. And so I think you just gotta probably experiment and see where you are in that spectrum.
Fantastic. Yeah, I tried to order Instacart today and they actually didn't have any delivery options. Like I couldn't do it today, for example. So I'm very, yeah, there's a lot of demand there and they're growing like crazy. So another question from Samantha: how do founders deal with low valuation if they are still fundraising during COVID-19?
So it's fun. I think the reality is in a bull market, investors don't have a lot of power and negotiating power. And so we are just paying high prices because it's just competitive. But in a recessionary period, investors have a lot of control over pricing and valuation. And so there is, quite frankly, nothing you really can do about pricing other than to just get a better term sheet from somebody else. And right now, even for our own portfolio companies, right, in which we're taking the dilution, if they're getting a term sheet like retraded, my recommendation is still close around as soon as possible, because if you're getting clean terms, even if it's at the last round valuation, it's probably better than like most of the processes I'm looking at right now, where they have very onerous terms, again, liquidation preference, all sorts of other stuff going on, or they're just like not getting term sheets converted at all.
Awesome. And then a question regarding that too. I know a lot of founders are trying to re-understand their customer, because now consumer behavior has changed so quickly, and now they're trying to like get a better sense of like, how can I best solve problems for my customer, which those problems have changed in many cases, right? And founders are having a hard time sort of doing customer development in a remote setting. Any suggestions or ideas you have on that, on what founders are doing to reach back out to their customers?
Yeah, I think companies that have like a great email, sort of like, email collection from their customer base are sending out maybe like really quick, I would say, like no more than 5-minute long surveys, and then incentivizing them with potentially like free products or discounted products. And that's like for example, like a good way to quickly reach out and get a high response from their customers. Also, customers are sitting around at home, and so they just have more time. And so you might actually have a much higher rate of, like, for example, survey response, just because people are just at home.
Yeah, and then sort of regarding that too is if you make pricing models or changes to be extremely friendly to your potential clients. Ken wants to know if that's the pain point they're having and you're looking to be flexible and solve that so you can keep your customers. How do you go about sort of adjusting your pricing model without gambling too much and maybe getting swooped by your competitors or putting yourself in a tough position?
Yeah, I mean, for consumer companies, I mean, across the board, we're seeing discounting. And interestingly, like because I mean, we have actually a large portfolio in China, so we get a lot of China information and also India information, but India is like behind us, China's ahead of us in terms of like experiencing the impact. In China, actually, e-commerce for the month of like, mid-Jan to like mid-March, sorry, mid-Feb, e-commerce flat to slightly up, which I have to say is not what we're seeing in our US portfolio. We're seeing e-commerce revenue being down in a lot of categories. And so again, this goes to like, I think every market is experiencing different trends on the consumer side. And I would say like on the enterprise side, you're just going to see lower enterprise demand. And so like in order to convert a sale, okay, I will say one thing on the enterprise side. What we're seeing is sales activity, so pipeline activity, is as strong as it was before the virus, but where we are starting to see like poor conversion is at close. So your Salesforce stage, like 6 prior to close, that's where we're seeing like, and some enterprise customers are like better at like, telling you what's going on with them and whether, you're just not going to make a sale until like Q2, Q3. And some are not, like, and so I would be really trying to keep in tune and ask like the key buyers on the enterprise side, like, what is it do you need to get this sale through? And that might mean like heavily discounted year one price that you're offering on a one-on-one basis, that you're not advertising on your website, but that you're doing to get it across the line.
Fantastic. And then Mohalis had a follow-up question. He said some of these terms you're seeing pop back up in these term sheets. You mentioned a few of them, preferred liquidation, things like that. Can you go over some of those?
Yeah, so terms, I'll talk about it both on the equity side and also on the debt side, because and also like we're very quickly getting to the point where this is just the new normal. But you can still be aware what you're signing up for. Okay, on equity, I am now seeing term sheets coming back with so I mean obviously lower price, also smaller amounts being put in, liquidation preference, which what liquidation preference, and you guys can obviously Google all this, but what it is that means that investors getting essentially getting like a multiple on the capital they put in off the top below the price of indifference. I'm going to actually not explain all these terms because I think it's probably going to be like kind of like boring for a lot of people to listen to, but there is a lot of great resources online. So liquidation preference, also seniority. So that means a new investor coming in senior preferred to everybody else on the cap in the cap table. They're also coming in with like participation, which is another which is like not only does the investor get to take potentially like liquidation preference off the top at your exit, but also they get to participate after they do that in the rest of the pot. So all of these terms we see back, absolutely more than 1x. I'm seeing like 2x, 3x, 4x, like we're kind of seeing. And by the way, this is exactly what was the environment when I was at Insight, like in 09 to 11. So it's just basically like a similar terms again to like the last recession, and we're only at the beginning of that. I think we're going to see more and more of those terms. When you have a lot of terms being presented to you in an equity term sheet, the liquidation preference is the most onerous, and so I would recommend putting a lot of your effort in getting that out as as a first priority, and then I would say like probably seniority, and then participation. It's like another turn of returns for investors, but I think it's like less painful than, for example, liquidation preference.
Fantastic. And so we only have a few minutes left, and so just a couple of closing questions. The first of which
before that, Rachel, really debt. The worst terms to have in your debt term sheet is actually covenants, because once you trip, and that's like covenants around like quick ratios, it's covenants around like, did you miss your top line target, for example, revenue or EBITDA by more than like X% of the plan that you are giving the bank, upon getting the term. And the reason is because lenders are very tight around freezing accounts if you trip up covenants. And so those are the most dangerous things to have in your debt term sheet.
Awesome. That's super important to know. And I'm glad you stopped me to share that with them. And then a couple things. So as founders are going about messaging what they're going to do, what their plan is to their people, whether that's their advisory board, their mentors, the people they have on board, if they're very early stage, and even their employees, do you have any tools or really tips for how to best handle those conversations and what to do in this sort of very uncertain time?
Yeah, it's a really good question. I mean, I think it's like a lot of empathy, and then just, nobody knows anything concretely right now, right? Like, and so I think just having your employees understand that you're figuring it out. There's a lot that you don't know, but that you're going to be transparent with them as to the extent that you can. And if you have to cut employees, explain like, we're living to fight another day. This is why we have to do it. Like, and we're going to try to hire everybody back when the environment changes, type of thing. To the extent, like, I would just try not to overpromise, underdeliver, because nobody knows the depths of this recession. Nobody knows how long people are going to be like, pretty much shelter in place is going to be in place. And so in that environment, I think it's totally fine to tell your employees that.
Awesome. And then as we're closing up, any last tips you have for founders at this time in terms of cash planning or otherwise? Yeah,
I think what we have seen really resonate in a lot of our companies is adopting that wartime mindset, and founders and CEOs really using, like, telling their employees, we are now in an absolute wartime. We're going to use this to get lean, get mean and lean, but then also like, you know, beat our competitors because we're that much leaner and more flexible than them, and we know where we need to continue to be aggressive. Like that kind of rallying cry has been really resonating across a lot of our companies.
Fantastic. Awesome. Well, Amy, thank you so much for your time. Thank you to everyone who put questions in the chat. This was a really great and very important conversation to have at this time. And we're just so grateful for you giving your time to us and for everyone being here today. So thank you to everyone for joining. If you are curious to see more of our startup events, please go to onlinestartupevents.com. And that's where we're here to support you as we, you know, the COVID-19 and the aftermath of it continues to unfold. We're here for you. Thanks, guys. Thank you, Amy.
Good luck, everybody. Keep safe and healthy.